Hey, I'm Shay Keister, and I'm your host for the Casual Cattle Conversations podcast, the beef producer's place to explore new management practices. Thanks for tuning in, and welcome to the community. Alrighty, folks, thank you for coming back to another episode, and if you're new, welcome to the show. Today, we are listening to Lee Schulz, and he's going to talk about how to understand cattle market trends and how to leverage that understanding in a way that's going to help you as a cattle producer be more profitable. And before we dive into this episode, I want to remind you all that I am booking for speaking gigs here. So if you are looking for a workshop presenter, a keynote speaker, a panel speaker, whatever it may be, I am open to discussing anything from podcasting, entrepreneurship, rural business, and even some advocacy. That's actually what I speak the most on, is how to advocate. So with that, you can email me at casualcattleconversations@gmail.com. And that link is also in the show notes. But with that, let's hear from Lee. Well, Lee, good morning, and thank you for joining me on the show today. I guess it might not be morning for listeners, depending on when they are tuning into this. So today we're going to be talking about kind of the trends in the cattle markets and the cattle cycle in general, and kind of what that means for cattle producers today, for those of you out there listening. I do want to put a little bit of a disclaimer on there that we are recording this the end of May, just so you're aware of the time frame of when we're recording and having this conversation. But Lee, thank you again. And to start off, I know you're an Iowa State guy. So would you kind of talk a little bit about what you're doing in the beef industry today, what your role is, and what your career looks like?
Sure. Well, thanks again for having me on. So here at Iowa State, I have a little bit of a unique role. I have a three-way split. So what that means is part of my time is dedicated to teaching. So we teach an agricultural marketing course where we let students really dig into futures and options and cash markets to really understand some of the markets that they participate in, as you know, their family's operations, as well as where they may be going in the industry. Then another part of my job is research. So that is really taking a look at, a lot of times the hot issues in the marketplace. So a lot of the work I've done over the last couple of years is related to price discovery, market resiliency, as we talked about impacts of COVID-19. And then the largest part of my job is extension. And so that's what I think we're going to talk a lot about today, is really understanding the markets. So the real fun stuff, right, of understanding where we are, where we may be going, and how we can maybe better position ourselves as we're entering different parts of the marketplace. And so I've been here at Iowa State for going on 11 years. So interestingly, we're going to talk about the cattle cycle. I've seen two cattle cycles now, or at least, parts of two cattle cycles. So we can kind of borrow some intuition and what's happened over the last several years, but also understanding that no two cattle cycles are alike. So we're going to have to tailor, a lot of the discussion and opportunities and threats maybe as we go forward, understanding that this situation is going to look a little bit different than it maybe has in the past.
Well, I appreciate you saying that no two cattle cycles are alike, but can you talk a little bit about what a traditional cattle cycle looks like, to give everyone just a basic background on that?
Sure. So at the heart of it, I think we need to remember that cattle production, like any other business, is a competitive industry, right? So this means that long-run economic profits are going to gravitate towards zero. That's not accounting profits, but economic profits are going to be very narrow in the long run. And what that means is producers are going to expand when they see profits. And by expanding, they're going to bid away the profits in the industry, going to trend towards zero. And then you're going to see some losses, maybe on average. And that's going to trigger some expansion or some contraction. And that's going to give rise to this cattle cycle. So usually we talk about cattle cycles, either production, so inventory numbers or beef production, or prices. And so when supplies are tight, you're going to see higher prices. When supplies are plentiful, you're going to see lower prices, right? This has been along forever, but as I mentioned, no two cattle cycles are alike. We've actually seen a flattening of the cattle cycle over time, and that makes a lot of sense. One big reason is we produce more beef from a single cow than we historically have, right? We're much more efficient. We feed cattle to heavier weights. And so that has really mitigated some of the large swings in cattle numbers. And that means that when we're in a period of expansion, we don't need as many cows as we historically did to get a bump in beef production. Similarly, we don't need as much contraction to get a decline in beef production. That, as I mentioned, kind of gives us a flatter cattle cycle over time.
So talk a little bit about what we're seeing today then in the cattle cycle and what that's really meaning for beef producers, because a lot of what I'm seeing is, a lot of states are still in drought. There's concerns there. Droughts been impacting us for a few years. So what are you kind of seeing, and what does that mean for the cow-calf producer today?
Well, we'll focus in on the national level, and then we can talk a little bit about regional impact. So as we look at the current cattle inventory cycle, so if we measure it from low or trough to trough, the current cycle began in 2014. So many of us remember 2014, right? We had come off a regional drought in 2011, a national drought in 2012, higher feed costs, lower forage base available because of the drought, and we culled numbers to lows of 50 years, right? And so we seen tight supplies in that period, and that triggered, with strong demand, a large expansionary period. And so we've seen inventories then peak in 2019. And we've seen our national inventories decline since that time. Now, most cattle cycles run 9 to 14 years. Well, if you do the math, we're at 9 years right now, and we're nowhere near the end of this current cattle cycle. So what that means is this cattle cycle is going to run longer, on the longer end of that 9 to 14 years. And so we're in a period of further contraction in the cattle industry. Part of that, we have to realize that we have to really get tighter before you get larger, because of the need to retain more heifers. So even when we start to see full-fledged expansion, that heifers, we're going to pull those from the cattle inventory that's going for beef supply. Well, that's going to tighten up supplies even more. Now, I think you mentioned, we have drought impacts, and if you look at the drought monitor, some regions have gotten better, some have actually gotten worse. I just looked at Iowa's drought monitor, and we actually, compared to this time last year, we're actually a little bit worse nationally, or a little bit worse in aggregate when you look at Iowa. So obviously regional impacts matter. And that's why I think is, if you look at back a couple of years ago, Iowa, we actually added beef cows January 1, 2021 compared to January 1, 2020. Well, the reason is we were one of the only places that really had grass available, right? And so I think as you've seen places like South Dakota see a lot of contraction because of less forage available, actually more cows physically came to Iowa. So you can see some situations where we maybe don't fit the cattle cycle in a particular year, but in aggregate, those numbers are going to vary in that trough to trough and period that we talked about.
So part of the reason, or really the main reason, I wanted to have you on to speak about cattle cycles, the markets in general, is because as beef producers, with us shifting more towards that business mindset, we really want to profit, and margins have been tight. So I kind of want to talk a little bit about your article. Let's see, what profits entice cattle producers to expand to capture more profits, I believe, right? That's the title. So I was reading through that, and you mentioned to hope for the best, but plan for the worst with where cattle markets are right now. Can you kind of expand on what you mean by that?
Sure. So there's a lot to maybe unpack from there. So first, I think, and foremost, is understanding producers respond to profits and not prices, right? And that's a very important distinction to make. So if you look at current prices, at least from a nominal standpoint, we won't go into debating, adjusting for inflation, but nominally, these are some of the best prices we've ever had, right? And so an outsider looking in may say, well, with these prices, we would see large expansion in the industry. But when we look at where costs are as high as they've ever been. So that means that profits are actually pretty modest right now. And there may be some producers that are not even making money at these very high prices because their cost situation is such. So I always talk about it, there's things that producers may want to do right now. I would want to expand in a, increasing market, but I may not be able to do that because of my current situation as it relates to costs, or I may still be dealing with a drought, in my current region. So that's limiting my ability now. So as we think about expanding going forward, I think we need to really take a calculated approach, because understanding that when we're looking at the current cattle market, we expect prices to go higher, right? But that may really want us to expand. And we've seen this back in 2014, right? With the levels of replacement heifer prices, those are some of the highest replacement heifer prices we ever seen. And at those current prices, they would pencil out. But we've seen rather quickly that prices eroded pretty quickly. And those replacement heifer prices probably didn't even make sense over the life of that investment. So I think as we think about staring at this current cattle market and relatively strong prices, I think we have to understand that, there are some investments that will pay off over the life of that investment. But there may be some that may not, just because we need to take an outlook on the cattle market. And I think give maybe a conservative approach when we think about where prices could go. So that's why I always like to talk to producers of, when you are, thinking about investments, run a lot of sensitivity analysis, right? Give me the best case scenario, give me the worst case scenario, and it's probably going to be somewhere in between, right? And if that investment makes sense under the worst case scenario, it's a no-brainer, right? But a lot of times I think we benchmark off the best case scenario, and then markets change for various reasons, and then we see that investment not be as profitable as maybe we expected.
So then what do they need to be analyzing within the markets to help figure those best and worst case scenarios and make sure that those investments do or don't pay off in the long run?
Yeah, so I think, we've changed a bit of the calculus on this because of interest rates, right? So, interest rates went from something historically low to interest rates that are much higher now, right? Than many of us have really experienced, right? And so, that changes the math on quite a bit of this. What I think of when I'm, thinking about investments in the cattle industry or changing is, understanding what my risks really are. So as a younger cattle producer or someone that's maybe very highly leveraged, they can't potentially sustain, large swings in the cattle market. So, I'll take us back to 2014. So let's learn a little bit from this last cattle cycle, right? So you've seen feedlot producers making, anywhere from, $200-$300 per head in October, November of 2014, right? They were paying really high prices for feeder cattle, but fed cattle prices were really strong, right? Now you look a year later and producers maybe were losing $400 per head. And that's because we had seen prices being bid up for those feeder cattle. And then we had an unexpected price slump starting in the summer of 2015. And so you're looking at paying high prices and all of a sudden your output prices relatively collapse. And so, there's a lot of risk in this market. We have price risk management tools to help take care of some of that risk. So we have futures, we have options. There's been federally inspected or federally supported livestock insurance since 2003. We've made some adjustments to those insurance products starting July 1, 2022. That's made them a little bit more attractive. So, I think anytime we think about large changes in the cattle cycle, so we are certainly, in a downturn of the inventories. prices are going higher. There's a lot of revenue at stake, right? So we need to talk about and think about price risk management and how it can help me really sustain a certain level of profits in the market.
Hey folks, I want to take a quick second to talk about a company that's truly helping beef producers advance their herds. Vitelli is the most accessible, reliable, and predictable reproductive solution. Operating in 21 countries with 15 global IVF labs, Vitelli is setting the new standard in bovine reproduction. Vitelli's simple, innovative, hormone-free IVF system allows you to multiply more of your best genetics faster. In the US, the 30-plus satellite partners and 7 regional labs makes it easier for you as a producer to access Vitelli's technology. Once you find a location near you, all you need to do is bring your cow. That's right, there is no donor setup or added labor. Their hormone-free process is easier on the cattle and simpler for you. Grade 1 embryos are created in the lab to the mating of your choice, and their simple, outcome-based pricing structure ensures you only pay for the embryo produced. Visit their website, www.vitelli.com, that's VYTELLE.com, to see how Vitelli can ensure your herd is always progressing, and that link is also in the show notes. So I'm curious about risk management since you brought it up. I know that wasn't going to be the main topic, but you mentioned it, so I want to ask a question about it. What are some risk management options outside of like your LRP insurance? Like what are you seeing producers do to manage risk outside of turning to insurance?
Sure. And so, I would turn that around maybe a little bit. I think the insurance products offer a lot of opportunity. And we
Absolutely.
haven't seen, historically a lot of risk there. So, that's where I've really, as I'm giving market outlook talks and price risk management talks, I'm encouraging producers to take a look at some of those, insurance products. We also have, the traditional products of futures markets, options, buying put options to help put a price floor, on our current market. When we think about price risk management, this is one of the hardest topics to teach in an increasing market, right? Because what do producers always, benchmark against is the highest price possible. So, if I am to, put a price floor in or hedge a price or buy livestock insurance and, put a floor price in or certain margin, and then I see prices go higher, I think, well, I left a bunch of money on the table, right? But that's not what price risk management's about, right? It's about mitigating losses and large losses, be it at that. So I think that's the mindset we have to a little bit have when we think about price risk management. Now we can certainly tailor our strategies to where the market's currently at. So, as we're in an increasing market, I think you want to leave the upside available, right? So something like LRP or put options allow for, increasing markets and to take advantage of that, as opposed to hedging a particular price.
Absolutely. Every tool has their place. I hear a lot of people, talk about some of the insurance options. So sometimes that's why I ask the question. I like to see, what else is out there too, but they all definitely have their place.
Sure, and definitely have their place for each individual producer, right? So, I always remind folks, be comfortable with the tools that you're using and understand what worked last year is not going to work this year, and what works for your neighbor may not work for you. So that's, being really knowledgeable. If that's something that isn't necessarily in your wheelhouse, working with someone that helps manage that price risk is very important.
Well, it's all about having a great team. That's something that I talk about quite a bit on the show, because we can't be an expert in everything. And cattle producers, they are certainly jacks of all trades as it is. So, we talked a little bit about how, margins are tight. We're trying to make a profit. And you talked a little bit about, where we're at with the markets, where yes, prices are high, but costs are still also high. So that margin's still tight. You mentioned in your article, you talked a little bit about expansion and when to and not to make the decision to expand. So can you kind of talk a little bit more and expand on, even though prices are up, when is it or isn't it the right decision to put those profits back into the business and expand?
So, I always sometimes start this discussion with, there's two basic principles here, right? First, buy low and sell high, and find out what everyone else is doing and doing the opposite, right? So if you can successfully do those, you're likely going to be more profitable. But I say that jokingly because that's a difficult strategy to follow, right? Especially the buy low and sell high. If everyone could do it, everyone would make a lot of money, right? So I think it's really understanding some approaches that you can take to maybe have the market work for you, right? So one approach that my predecessor did quite a bit of work on is understanding investment strategies, and some of the work that he found is that you can think about like dollar cost averaging. So I'm spending the same amount on replacement heifers regardless of where the market's at. So instead of replacing the same number of heifers every year, some years they're going to cost a lot more, some years they're going to cost a lot less. I'm going to spend the same dollar amount, right? So when replacement heifer prices are relatively low, that means I'm going to buy more replacement heifers, right? And when they're really high, I'm going to buy fewer replacement heifers. But what that means is I'm going to actually target the market a little bit better because I'm going to have more replacement heifers and cows to market calves at higher prices due to the biology related to that cattle cycle. And so that'll help me time that market a little bit better. Now, let's think back to that last cattle cycle. So when we seen really large profits in cow-calf production last time was 2014, 2015. What happened? Replacement heifer prices went through the roof, right? There was a lot of demand for those replacement heifers because of the profitability that was going on in the industry. Well, let's think about the calves from those replacement heifers. What kind of market was I marketed into? Some of the lowest calf prices that we've seen, right? Because we've seen that expansion, that full-fledged expansion take place. We bid away those profits, and then we see much tighter prices. And that's where I'm marketing those calves from those very high replacement heifers. So I think that's really important to keep in mind of, there's ability to, I think, tailor some strategies to time this market a little bit better. Another way is if you think about it, and I wrote an article maybe 6 months ago to say, well, you may look at older cows right now that are available because that helps me speed it up a little bit quicker to have a calf available as opposed to, raising or buying a replacement heifer that's going to take a little bit longer to get a calf from. And so there, the case was that, I think some of those cows were undervalued a little bit, and I could take an older cow, get a couple calves out of her, and that would time out really well where we're going to see some of the highest calf prices in the next couple of years.
So if a cattle producer out there is listening to this podcast and they really want to say, I want to manage for profitability, I want to make sure that I'm keeping an open mind and watching the markets, what is one of the biggest things they can do to manage for profitability?
I think it's making sure an investment fits with the long-term business plan, right? So, and in that article you mentioned, we talk about when we see high profits, we see investment. And then when that profitability wanes, we see liquidation. And unfortunately on a lower market typically. So, I think you got to think about decisions, how they're going to impact expenses, cash flow, debt, and investment, and then get into some specifics. So think about investments that have really high expected payoffs. So this can include cattle genetics, improving the forage base, either quantity and or quality, making repairs, expanding infrastructure, acquiring productive assets, investing in technology that's going to pay off over the long run, and making some tweaks in production activity. So, in economics, we talk a lot about ensuring marginal benefits equal or exceed marginal costs, right? So making sure my inputs are having the biggest impact on my outputs. And then a big payback is always reducing debt, right? Now, that's a little bit more difficult if depending on when that debt was incurred, right? And where the interest rates were. Because that's maybe some of the cheapest money that I've ever gotten in the form of debt. So, but again, typically that's been a large payoff is in reducing debt for the operation.
So as we kind of wrap up today, what final thoughts or advice would you like to share with all the cow-calf producers out there who are trying to be proactive and understand what's going on in the cattle markets?
Well, I think, as you mentioned, certainly working with your team of experts is critically important. A lot gets made about, really dialing in and making important decisions in bad times, right? But as we're in relatively good times in the cattle industry, I think some of those decisions that are made now collectively with your team of experts are going to be some of the most important decisions that you make, right? Because that's going to set you up for the next downturn in cattle prices, which will likely be tighter profits in the industry. And so I think you got to think about how you can set yourself up for that situation coming forward. Also, I remind folks, and this is hard to do, I think, as we talk about some cattle producers, is that enjoy a prosperous cattle market. So, as we think about, where to invest some of these profits, personal use is part of that, right? So, that may be in line with, some operational goals is taking advantage of a prosperous market. A lot of times that obviously comes after, prioritizing a lot of some of the investments, in the cattle operation.
Alrighty, Lee. Well, thank you very much for joining me on the show today and really sharing your knowledge with all the listeners out there today.
Well, thank you for having me.
And that's a wrap on that one, folks. Thank you for tuning in today and joining in on the conversation. Be sure to take this a step further and take the advice you learned and implement it on your operation. If you want to have a conversation about it, head over to my social media and send me a DM by following @CattleConvos and connecting with me there. Have a great day.